There we go. Very good. So let's get started. Welcome, everyone. Thank you for joining us. This meeting is recorded, and I am extremely privileged and very happy to welcome Dr. Dora Grunwald, who is going to talk to us about quantifying crypto disputes. She is a partner at a boutique economic and financial consulting firm called Osborne Partners. And she has a PhD in economics and a master's in finance. And her work combines finance, economics, and econometrics. She has been involved in several cases in arbitration, investor state, and commercial disputes. She is an expert, has been appointed on multiple occasions. Particularly, she says in her bio, in relation to solar power disputes in Spain, Italy, and Ukraine. She is currently involved in a dispute concerning cryptocurrency trading, Binance, which is not to name it, which we are going to talk about a little later, and which really, I think, puts at the forefront the importance and the challenges of quantifying crypto dispute. Dora is also lectures in university and academic settings, and her topics cover the valuation of damages in renewables disputes, the efficiency of stock markets, and the fair value of assets in specific types of litigation. Welcome, Dora. Thank you so much for saying yes to this conversation with ArbTech. I am going to let you speak to us to your presentation. Everyone, this is a presentation that Dora has given elsewhere, but this time we've asked her to really concentrate on the nerdy part of quantification, because it is quite important to understand that this is different in many ways from the quantification of the assets, the non-digital assets, the physical assets that we know. And I wanted to say just before we start, please ask any questions, make any comments in the chat box. We will probably take those at the end. Otherwise, we might also monitor it during the conversation, so that. But do bring your ideas and your questions in the chat box. I'm also very grateful that we have some experts in the audience who will have, I'm sure, technical and questions that might be very different from what lawyers have to say. And please, they're very much invited to chime in with their ideas and thoughts. And Dora, thank you for saying yes to this as well. Please go ahead.
Thank you very much. Thank you, Sophie, for the invitation. And thank you all for dialing in. So Sophie mentioned that I can skip this time the basics of cryptos and the blockchain. So I'm going to jump right in. I'm just going to check whether you can see the slides well. So to start, let's just look at what types of cryptos are. And in order to do that, we need to understand what they are used for. So to understand what they are used for, we could start by looking at Bitcoin. And I'm just going to see if I can get to the next slide. So there are differing estimates of what Bitcoins are used for. One of those that are presented on this slide is by Chainalysis from 2020. As we all know, by now, there are more than 19 million coins in circulation. Of those, as of 2020, more than 11 million were held as investment. So somebody bought the coins, and the coins were in their wallets for a considerable amount of time. And nearly 4 million of those coins were assumed to be lost, and more than 3 million were trading. So around 340,000 people were actively trading Bitcoin every week in that year. And these were mostly retail traders who deposit less than $10,000 worth of Bitcoin on the exchanges at a time. The remaining 4% are active traders of Bitcoin. So now basically we can conclude, right, that mostly the coins are used for trading, and they are not widely accepted for purchasing products and services or any other use. So Professor Damodaran, who is a finance guru from the New York University NYU, and who is often cited by damages experts, has the following thesis: not everything can be valued, but almost everything can be priced. Okay. So Professor Damodaran classifies assets into the following 4 groups. You have cash-generating assets, commodities, currencies, and collectibles. So cash-generating assets are businesses that are expected to generate cash flows, as well as various claims on those cash flows of those businesses, including stocks and debt, shares and bonds. These cash flows or these assets can be valued because the cash flows can be valued. And as we know, assets with higher cash flows and lower risk should have higher values than assets with lower cash flows and lower risk. These assets can also be priced with respect to each other, and we use common metrics such as, for example, enterprise value per EBITDA or enterprise value per revenues to compare the prices of different assets. Commodities derive their value from their use as a raw material into some fundamental needs. So this can be production of food or energy or something else. While the value is really given by the supply and demand for these commodities, valuation can be very cumbersome and complicated because there are long lead and lag times in production and for other reasons. So they tend not to be valued, but they tend to be priced. And often they are priced with respect to their historical price trend. The third class is currency, right? The currency is a medium of exchange that we can use to denominate cash flows. It's a store of purchasing power. It doesn't generate cash flows, but it can be priced vis-a-vis other currencies. And currencies that are better able to store value over time and are more widely accepted by people should see their prices rise with respect to currencies that don't have these properties. And then finally, collectibles have no cash flows either. They are not a medium of exchange, but they can have aesthetic values, and they can be priced based on the perceived desirability and the scarcity of the collectible. So to give one example of how we would classify an asset, gold is a commodity, of course, but it is much more commonly held by investors as a currency, so it would rather fall in the category of currencies. And the takeaway from this slide really is that it's cash generating assets that we typically value. The rest of the groups are typically priced. Okay, so the cash generating assets, we can use discounted cash flow methodology to value the asset. For the others, there are pricing methodologies. Right. So just to give a little more flavor to the difference between pricing and valuation, Professor Damodaran describes, and I would point out the third row on this table, the key drivers of price are demand and supply, which in turn can be affected by mood and momentum, whereas the value is determined by cash flows, growth, and risk. Okay, and the Damodaran would say that traders are primarily in the pricing game. So they would try to anticipate which direction prices move and act on that expectation, whereas investors would evaluate the assets, would value the assets and compare it to the actual price of the assets. And if the asset is overpriced, they would buy. Right. So before turning to the question of whether cryptos are currencies or commodities or another type of asset, let's just quickly review the key functions of currencies. Right? So there are three particular functions that they should be able to fulfill. So money is a store of value. If I earn $25 today, I can hold on to it, and I will be able to spend $25 tomorrow or a year later because it will hold its value much better than other instruments typically, although it's not a perfect store of value. As we know, inflation erodes the value, and of course, countries that experience hyperinflation have less desirable currencies. Second property is that money is a unit of account. So basically everything that is fungible, divisible, and countable can be used as a unit of account. But of course, there are more or less practical options. And then thirdly, money is a medium of exchange. So it has to be widely accepted as a method of payment for something to be a currency. Now, based on these functions, we can quite quickly conclude that Bitcoin does not satisfy the first and the third criteria, because at the moment, Bitcoin's price is too volatile to be considered a store of value. And it is also not widely accepted as a method of payment, at least for now. Right, so Professor De Modern states that Bitcoin doesn't generate cash flows, so it's not a cash generating asset, and it is not really a commodity either. So of the remaining two categories, it can either be a currency or a collectible. And he states that supporters of Bitcoin would view it as the former, a currency, and skeptics would suggest that it's more like a collectible. Professor De Modern himself views Bitcoin as a currency, just not a good one. In 2017, he saw three possible pathways for Bitcoin. In the best case scenario, Bitcoin would gain wide acceptance in transactions across the world, and it will be used as a global digital currency. In the mid scenario, it would become the gold for millennials. So it would become an investment opportunity for those who are dissatisfied with central banks and governments and fiat currencies. So in short, it would take up the position that gold historically has taken. And then in the third option, it would become the 21st century tulip bulb, referring to the tulip bulb situation in the 1600s in Holland. So it would see its prices soar before fully collapsing in the aftermath. In 2021, Professor De Modern commented that Bitcoin now is in his view, millennial gold. There are, of course, alternative views. Some people point out that Bitcoin's target markets include global remittances, which is in itself a $700 billion market. it targets markets such as payment processing solutions, microtransactions. And so in their view, it would be possible to value Bitcoin based on the probabilities of various penetration rates in those different target markets that it might achieve in different points in time.
Dora, I'm sorry, I said I wouldn't jump in, but I'm going to jump in with small about El Salvador, right? What would Professor Damodaran have to say about that? Because it is currency there. If you were to value it before a tribunal to do with, I don't know, something that is germane to that market, would this be a different valuation because it is the currency?
Since currencies and collectibles are both priced, so they have prices that we don't do valuations because they don't have cash flows. It's the same in El Salvador and everywhere else. So just because it has been accepted as legal tender, I don't think it would face any different approach. I mean, the real differentiation here is between assets that generate cash flows over time, so we can forecast those cash flows, look at their riskiness, attach a discount rate to them. That's the sort of valuation that he differentiates from looking at the trading prices of the other types of assets. Okay, so we have looked at Bitcoin, but of course there are lots of other types of tokens, and it's worth looking at them as well. The UK's regulator, the Financial Conduct Authority, has recently published its guidance on crypto assets, in which it classified tokens according to how they fit with existing regulation. So there are many ways of classifying them, but this is one that the FCA adopted. So there are tokens that are e-money tokens because they meet the definition of electronic money, and they are regulated under the electronic money regulations. Some of the stable coins apparently could belong into this category. There are security tokens that are like investments, like a debt instrument or a stock. These are practically tokenized digital forms of traditional securities, such as shares and bonds. And then the third category is unregulated tokens. These can also fall into two further categories. There are utility tokens, tokens that are used within a certain platform, and they can access services, for example, online cloud storage or Claros as an example, which should be well known in the legal community. And then there are what they called exchange tokens, which is the Bitcoin and Ethereum and others that are used as means of exchange currently. Now, the UK has some position of these tokens, in particular exchange tokens. The Treasury clearly doesn't see exchange tokens as currency at the moment. It notes the high volatility, which makes them useful for payment purposes and are more attractive to be held as high-risk speculative investment for some people. So they are too volatile to be widely used as a currency or a store of value. And the FBC further stated that, which is exactly what Professor Damodaran says as well, that they establish no claim on any future income streams or collateral. They have no intrinsic value other than their currently limited potential to be adopted as money in the future, and hence could prove worthless. So that's about exchange tokens. So the UK obviously doesn't see them as currencies at the moment. Stable tokens, on the other hand, is something that they are watching more carefully because they believe that certain stable coins could play an important role in retail and cross-border payments. And so therefore they are looking into regulating it because they can pose risks to financial stability and market integrity, and some other risks as well. So what about the other categories of tokens? We said that there are the security tokens, which are like shares and bonds, but in digital forms. So they obviously are cash generating assets. So they could be valued. They are quite different from the exchange tokens and the stable coins. And the utility tokens, for example, Clarus, well, that's a question, right? So Sophie would obviously be able to explain a lot better how Clarus works, but basically arbitrator candidates have to stake some coins at the platform to be selected to be on the panel of a dispute. And if they are successful in terms of how they vote, if they vote with the majority on the outcome of the dispute, then they will generate some cash flows, right? So they'll get some of the money that has been put down as a stake, and also the money that the parties put up for financing the dispute. So those could potentially be viewed as well as cash generating asset, but of course there are many different types of utility tokens. So so every case would need to be assessed separately. Right. So I'm going to move now. Basically, that is the characterization of the different types of cryptos into different asset classes and whether we would look at valuing them or not. In terms of different cryptocurrency disputes, as you probably all know, there are areas of disputes that include disputes over the transfers of cryptocurrencies, the operation of smart contracts, since they are susceptible to hacking. There could be disputes around that or around fraud and the potential for violating sanction regimes and money laundering rules and so on. There have been some disputes around initial coin offerings or ICOs. So these are the security tokens that I have talked about before. Basically, businesses financing themselves by issuing tokens. I know of one case that has recently settled, but there isn't much information at all about how the tokens were valued or how the settlement amount was derived. And then finally, there is, of course, the area of trading disputes concerning cryptocurrencies and their derivatives. And I'm going to talk a little bit more about these. But before doing so, I need to talk about what these derivatives are. So, of course, if you'd like to invest in Bitcoin, you can just buy the coin itself, and you would do so if you expect the price of Bitcoin to go up. And it's fairly straightforward. The amount invested can be as little as £1, and if the price of the coin goes up by 10%, then you have £1.1, and then if it goes down by 10%, you have a little less. But there are obviously many derivative products that you can try your luck with. So there are, for example, futures contracts, which is basically a contract between a buyer who expects the Bitcoin's price to rise, and the seller who expects the Bitcoin's price to fall. And the interesting thing about futures is that they allow you to use leverage. So you can take up a much larger position than what you originally invest, but it can result in liquidation if you don't maintain a required margin. So let's talk a little bit about how it works. So if you expect the price of Bitcoin to rise, you can open a long future position with, say, £100, and you can tell the exchange that you want to use 20 times leverage. So you can open a position of £2,000 worth. And the initial $100 or pound that you invested is your initial margin. So you can do that, but the exchange will tell you that at all times you will be required to maintain a margin of around £10. Now, if the price of Bitcoin goes up by 5%, you gain £100. It's your position, £2,000 times 5%, £100. So this is a 100% return on your initial investment. If the price of Bitcoin goes down, on the other hand, by 5%, you lose £100 and your initial investment is wiped out. However, before this happens, before you actually reach your £10 margin that you're required to maintain at all times, the exchange will notify you and will tell you, put in more money or close your position, or do something, otherwise your position will be liquidated. And unless you provide additional funds, your position will be liquidated. So one thing that can happen to exchanges is obviously outage, and that's what happened to Binance on May 19th, 2020 in 2021. It was a day when the prices of Bitcoin and Ethereum dropped very substantially by over 30% and 45% respectively. And during the outage, the traders were unable to close or modify their positions, and many traders were liquidated. So one trader described what happened, as you can see on the slide. He tried to close his position. He was on the long side of a futures contract. He tried to close his position, clicking on the app 70 plus times, and try to put in a stop loss, tried everything, all functions that he could, but nothing worked. So eventually his position got fully liquidated. There were traders who had the opposite problem. So another trader describes his experience in the following way. He had a short position on a Bitcoin futures contract that he took out in April 2021, and on May 19, this short position started gaining a lot of value as the price collapsed, but because the app wasn't working, he couldn't close out of his position either, so he couldn't realize the gain. Instead, by the time the app started working again, the price was the same, regained its value. So his opportunity to make really significant profits evaporated. And instead, what actually happened, but it's obviously the trader's fault, he was hoping for the market to turn bearish again, the prices to slide again, but instead they kept rising. So he got liquidated on the upside. Now, another type of product is leveraged tokens. These are derivatives of derivatives. They are very complex products. They are also leveraged, as the name suggests, but the advantage is, in principle, that they have built-in mechanisms which help avoid having to maintain a margin or getting liquidated. So examples of these tokens are ETH and ETH done. ETH offers leveraged gains when the price of Ethereum futures rises, and ETH promises leveraged gains when the price of Ethereum futures falls. You can see how Binance describes this product in the yellow circle quite simply. ETH will generate 1.25 times to 4 times leveraged gains when the price of Ethereum futures rises. So on the day of the outage, token holders were complaining of faulty pricing behavior, faulty token prices, and they did. You can see on the left slide on the left side of the slide that where the yellow arrow points, that there is an increase of the futures prices between the 2 points that I'm indicating. And at the same time, the ETH prices did not go up, such as you would expect, given the futures prices increased, but instead the ETH prices collapsed. So not only did they collapse on the day, but the following slide shows what happened with the futures prices since then up to date. You can see I tried to indicate the same moments of May 19th on these charts, which go out all the way to today. And you can see that Ethereum futures prices regained their previous heights, whereas the Ether price just stayed where it was, never got back to that level where they were on May 19th. So here is an example of a token trader's complaint. So this trader states that on 19th of May, he bought a certain number of ETH tokens for around $200,000. And at the time of purchase, the token price was $278. The Ethereum futures price at the same time was $2,969. He sold these tokens the following day when the Ethereum price was $2,784. So the futures price declined by 6% between the time of purchase and the time of sales. And Trader White claims that if we take average leverage of 2 times, the value of his position should have fallen by 12%, right? The Ethereum futures price declines by 6%, then the token price should have declined by 12%. Instead, what happened, according to the claim, due to faulty token behavior, the position lost 70% of the value. And you can see the price at which it was able to sell was $84. So he claims losses of 58% of his original investments. So the difference between the 70% value loss and what he thinks the correct 12% value loss should have been. He also bought a second tranche of tokens on May 19th, a little bit later than the initial buy. And at this time, he bought at a token price of $236. Again, the same story. He sold the tokens exactly at the same time as the first tranche the following day. And by that time, Ethereum futures lost 4% of its value. So he says with a leverage of 2 times, his position on this tranche should have lost 8%. Instead, due to faulty token behavior, it lost 64% of the value. So again, he claims losses of 56% of the original investment, which is the difference between the 64% actual loss in price and what he says the correct loss of 8% should have been. Now, what's notable, however, is that the trader sold all of his tokens at the same time on the 20th of May, but the implied closing prices for the 2 tranches are different, even though they are sold at the same time. So based on the first claim, the price should have been $278 times 88%, so $245. And according to the second claim, the price at the time of sale should have been $217. So there is obviously something not quite consistent with the claim, and it may be that there is a misunderstanding of how the tokens should be working, but also there could be a problem with already the initial pricing at which he purchased. So there could be mispricing already there. So this needs to be investigated. Right, so both types of traders, the futures traders and the token traders, claim that they have suffered losses. And these types of claims raise a few issues for the damages assessment. These include the theory of loss, include issues related to black box algorithms that the exchanges use, and various information issues, which I'll discuss a bit later on. So in order to talk about the theory of loss, I thought we could start with a simple example, hypothetical example, where 1 Bitcoin is unlawfully taken away from claimant in December 2020, when the price of Bitcoin was around $20,000. Today, as we know, the price is around $40,000. Now note that Bitcoin can be lent to earn interest, and currently the rate is around 7–8% per year on a number of sites such as crypto.com and Accru. So what amount should be awarded, right? And let's start by this well-known quote from, I'm just going to call it C Factory. Reparation must, as far as possible, wipe out all the consequences of the illegal act and re-establish the situation which would, in all probability, have existed if that act had not been committed. Restitution in kind, or if this is not possible, payment of a sum corresponding to the value which a restitution in kind would bear. Right? So, of course, there is already a question whether this standard of reparation applies in the particular case, but if it applies, then the next question is restitution in kind possible and allowed by, and that's a legal question, of course. But if it is allowed, then we can, of course, make full reparation by providing 1 Bitcoin plus potentially some interest. Of course, there is some residual question that remains of whether the whether the claimant would have held the Bitcoin up to date. And if you remember the previous chart, between the $20,000 price and the $40,000 price, we saw a lot of fluctuation. The price went up to all the way to $67,000 at some point. But then, of course, we are also talking about traders, not, well, could be a trader, could be a holder. A question is, what kind of person is the claimant? So that's a question as well. So would the claimant have held the Bitcoin up until today? If not, what do we do about that? Now, if restitution in kind is not allowed for some reason, then obviously we can get to compensation. And of course, the aim of an award for damages is to restore the claimant to the financial position it would have been in, but for the respondent's breach. And we typically calculate damages as the difference between the financial position the claimant is actually in, so that's the actual scenario, and the financial position that claimant would have been in, but for the breach, which is the but-for scenario. So one interesting question is the date of assessment. Should we compensate as of the date of the breach or as of the date of the award? And this is a legal question again, one that can have material impact on damages. It's a legal issue, and it's related to questions such as the compensatory principle, issues of certainty of loss, of the requirement to mitigate losses, and other questions. So, for example, one argument which could be made with respect to the date of breach is that the claimant could have easily mitigated the losses by borrowing some money and buying another Bitcoin, right? And this argument may work in case of some claimants, but might not work in the case of other claimants. If we award the monetary value of the Bitcoin as of the time of the breach, we would usually award some interest. Whereas if we award the damages, the monetary values at the time of the award, it is almost like awarding the Bitcoin itself. So going now to the discussion of interest, maybe just to state that valuations, these are not even valuations, right? This is a pricing question. And once the legal questions of whether it's restitution or compensation, what is the date of assessment, whether interest should be applied or not, the calculations are pretty straightforward. With respect to interest, basically the purpose of awarding it when we utilize the date of breach as the date of assessment is that compensation that would have been due as at the time of the breach could have been, the monetary value could have been used by the claimant to generate some returns. And this is not a settled issue. Many international investment treaties specify that interest should be awarded at a commercial rate, but they don't go much further than that. The commonly proposed rates include the risk-free rate, the claimant's cost of debt, the claimant's cost of capital, or the respondent's cost of debt. And, one question that sometimes arises is, should we award rates that are higher than the risk-free rate, given that the claimant does not or did not bear the risk of investing in something that would have earned a higher rate of return than the risk-free rate. Another question that might arise with respect to this particular situation with Bitcoin is, would the claimant have lent the Bitcoin to earn that rate, the Bitcoin rate of return, unlike the many holders of Bitcoin who just keep them in their wallets and they don't lend them out? So again, it depends on the facts of the case and the type of claimant of what kind of arguments might work.
Dora, on this, can I just, I mean, I'm very exercised by the question of interest, because it sounds to me like, I wonder if it should even apply at this stage anyway of the use of crypto, because as you said very, very rightly, users and players, to call them like that, are very varied in their attitude to it, right? You have those who stash it in a wallet and it stays there. And unlike a bank account or let's say an investment portfolio, crypto is not going to earn anything by staying in your wallet. So why would you even consider, or would someone, would a decision maker have to look at the behavior of that particular claimant with their crypto to then decide whether interest should be awarded? What would you think?
So I think it's partly a question, but if you decided that it's a restitution, right, so you're going to award the Bitcoin, then I do think that you might want to look at whether the particular claimant is a type of person who would lend it out, because that is definitely an additional loss of value. You know, 8-10% rates are not negligible. The other issue, if you award the monetary value as of 20, what did I say? I think 2017. What was it? Like the date of breach?
Yes.
$20,000. I think. Yes, at least the risk-free rate we typically award, because then you hypothesize that the compensation is made at the time of the breach, and that value is available for the claimant to earn, to put it in the bank or earn a risk-free rate on.
Because I'm thinking about this because I've come across a very recent decision by the English High Court called Tulip Trading versus Bitcoin Association, where the claimant claimed that he had about $1 million worth of Bitcoin in his wallet that was hacked, and he could not recover it because the private key was erased. So in his case, that's not what he claimed, but had he claimed compensation back for that $1 million, I don't see how he could have claimed interest, because it sat there for 12 years earning nothing. So that's why that's the purpose of my question. Whereas your traders that you talked about, who are very active and probably would have gone ahead and lent. So it's a very different ballgame, right?
Yeah. Yes. I think, you know, you can argue both ways. So Bitcoin holders, you know, obviously expect that the real value is coming from the price movements. But I still wouldn't really understand why they wouldn't lend out the Bitcoin if they can also do that. But I'm not even sure that it's that widely known that you can actually earn these rates of returns. I mean, would you hold the money if you get a compensation in your wallet? Probably not. I think it's a natural assumption that you would at least, but risk-free rates are next to nothing anyway. So they probably wouldn't make a very big difference. I mean, I think if the claimant argued at that point that they would have invested in something much higher return investment, then that would be a very more difficult one to accept. Right. So that's about interest. And then talking a little bit about the theory of loss in the case of liquidation. So one thing to note first is that the margin that you need to put down to initiate a futures contract on Binance is in Bitcoin or Ether or Tether, right? So it is coin based, and also the contracts are settled in coins. So if there are losses, those will be crypto losses. They are not settled in fiat currencies. The other thing to note that it's obviously depends, the theory of loss depend on the contract between the trader and Binance. But setting that aside, one would need to prove that the trader would have closed the position at a certain point in time, and you know, at that point the calculation is fairly simple, right? The position would have been worth the position if he had managed to close it. And then we get back to the same issues as with the Bitcoin of would you award, is it restitution or is it compensation, and what is the date of assessment? Is it the date of the outage or is it today, and what interest you award?
So I wondered about that, because you mentioned, I wonder whether the Trossau factory test is the right one for this, because the but-for scenario is not an obvious one for cryptocurrency. First of all, this is not a case where you have an investment and there's an expropriation or a license taken away. That investment was going to go forward according to a certain path, and there is a projection of certain earnings. Crypto is extremely volatile. The behavior of those who hold it is extremely unpredictable and highly emotional. And so the but-for scenario to me is a difficult one to apply to, unless I'm missing something.
No, but I think that's why if you look at just the position on the day, right? So if you hypothesize that the futures trader who was on the long side would have closed out of the position, then you don't really need to construct a hypothetical scenario of what would then have happened, right? You have the coins at that point in time, and you can, as you said, if you don't believe that the trader would have held it for long, you might just want to say on that day that was the position, that was the monetary value of that position, and you can award that value, and then you can again decide what interest to give. But I think that's exactly the point that and I think that it is probably both a legal and a question of understanding the trader's past behavior and so on, or if it's not a trader. I mean, in this case we are talking about traders, but there are obviously other crypto holders, so their past behaviors, how they utilize the tokens and what their aims were with them. And so the same is the situation though with the short trader on the short side of the contract, right? Who also needs to prove that they would have closed and realized their gains at a particular point in time, and either you can do that or you can look at it as a loss of a chance to earn profits, and maybe look at different probabilities of closing out of the contract in different points in time. Well, this particular trader is unfortunate, but because when the prices recovered and the trading was possible, you know, he stuck with his position, and instead of the prices going down, they went up. So he got fully liquidated. So it's partly his fault that he lost all of the money, but it's also not a particularly good indicator of timing the market, right? So So that's about the short seller. In terms of, I think yes. So in terms of the theory of loss in the case of the potential token misbehavior. So first of all, whether the tokens were mispriced needs to be demonstrated, and that's a pretty complicated issue in itself. Partly because of the black box algorithm that I referred to earlier, of how, I didn't get into the details of how complex these products are, but there is some re-leveraging going on and issuance of new tokens all the time. And one needs to understand that process pretty well before being able to comment on how the pricing worked and whether it worked as it should have. But one thing is clear, that that the tokens could not have behaved in the way the traders described they should have behaved. And this simple numerical example on the slide should clarify why. So on the left side of this little table, you can see Ethereum futures prices, a hypothetical scenario, and on the right side, the ETOP token prices. So if we start from a situation when Ethereum futures are priced at $1,000 and the corresponding ETOP price is $100, and imagine that the futures price drops by 30%. So the new price is $700. The ETOP tokens price at 3 times leverage would be 90% down, right? So 3 times 30%, 90% down. And the price of ETOP would fall to $10. Now, if then the Ethereum futures price goes back up by 43%, and I selected this number so that we recover to the original level of price, or a bit more actually, to $1,001. If the ETOP token goes up by 3 times 43%, so by 129%, the ETOP price is still only $23. So it's still well below the original price. And that's exactly why we see that flattened out ETOP price on the previous charts that I showed you. So it's just mathematically, even the price behaves as on the label, every consecutive transaction, the ETOP token price follows perfectly the Ethereum futures movement, across a longer period. You can see on the left side of the slide, the Ethereum price goes up actually from 1,000 to 1,001. But the ETOP price is still shows a big fall between those two trades. So it's still a big question of whether there is any mispricing, but there are definitely some issues. For example, these products target a certain range of leverage. And on that day, the actual leverage was often well out of the range. So whether that's mispricing or not, it probably depends on the contract. But in any case, there is the issue that many people don't seem to understand how the product really works, and maybe that's why, in fact, effective 6th January 2021. The sale of cryptocurrency derivatives are banned in the UK to retail consumers. And you can see the FCA cited some issues, including the inadequate understanding of crypto assets by retail consumers, and the underlying nature, the nature of the underlying assets, that they have no reliable basis for valuation, and so on. Extreme price volatility. So that's that, and then the other topic that I wanted to briefly talk about is data issues. So partly there is an information asymmetry between the exchange and then the quantum experts, right? The exchange has a huge volume of not necessarily publicly available information. And then, of course, there's a large number of claimants with their own specific situations and information and data. And one real issue is the sheer volume of data. So the chart that you are currently looking at is based originally on 121 million data points. Of course, Excel cannot work with this amount of data. This is just trading data one day. But because there are multiple transactions every millisecond, so just one day produces 121 million data points. So we used Python to store and analyze and visualize data. And of course, as I said, you have to use different tools other than Excel, but they are actually pretty powerful. And you can zoom in, you can look at various sections of the data, so they are quite useful. And the last video just to show the depths of market data. So this is actually not the actual transaction data, but the order book of buy limits and buy stops, and so the sell stops and so on. So these are not active trades. And what you can see here is on the x-axis, you can see the price of Bitcoin, and on the y-axis, you have the volume, the cumulative volume of orders. And I'm just going to play this again. The red is the buy side, and actually red should be the sell side, and green is the buy side. And you can look at it for a long time and try to understand what actually is happening. But one thing that you can see is that the order book is reducing pretty rapidly over the day. So that's about data issues. And so in conclusion, I think that was my last slide. But I wanted to conclude that, in some disputes, the quantum assessment is fairly straightforward once some of the legal issues are cleared away, because there isn't much valuation to be done. It's more the prices that are observed. But there are some other cases where the quantum piece can be pretty complex quite rapidly, and also exacerbated with data issues and technology issues, including the algorithms and so on.
Fantastic, thank you so much. We have a comment and a question. I'm going to start with the comment from David Wilson, who says that under US state laws, such as Colorado, a successful claimant would be entitled to receive prejudgment interest at the statutory rate where property is wrongfully withheld. And that is measured from the date of the wrong, and that he says this analysis would apply in tort and contract cases involving crypto. I know nothing about the US law position on this, but I would question whether we're talking about property wrongfully withheld in the case of Binance. That's an interesting legal question, I guess, or factual question in itself. Sean McCarthy has a question on the futures example that you gave, Dora, and it says, what would the expert opinion be where a market run by one exchange for a certain token lacks the required liquidity to stabilize prices in short but highly volatile periods of time versus other exchanges? This clearly would have a direct impact on how far the price would decrease or increase and whether it would liquidate the party involved. Does a market-wide average price analysis come into it?
Well, that's a complex.
That would be Sean McCarthy, my co-moderator on ArbTech. He always has these very involved questions, but it's a very valid one, obviously. I suppose it would be one approach to have a market-wide average.
So let's just summarize what the question is. The exchange is not able to stabilize the price, right? And whereas other exchanges have different prices, and the claimant would claim losses because there is volatility. What is the claim exactly?
Maybe I can address it.
Why don't you do that, Sean?
The question
Thank you.
really is more about a flash crash. So we see that quite a lot in different crypto exchanges that don't have the liquidity of some of the larger ones. And something like an exchange called Kraken is infamous for the past 5 years for when there's high volatility, like on that day, that it crashes 10 to 15% more than any other exchanges. So I just wondered, say in the ETH example, where clearly there's a liquidity element involved, where it may not track exactly the underlying futures price, or just the standard price of an Ethereum future over maybe an hour-long period. If there's no liquidity to back up the price, people are panicking and just pressing market sell, and then the price drops and then it bounces back up. But if it had the liquidity, it wouldn't have done that. And so my question there then is, if you're taking a market-wide average price over that same period of time, could you therefore say, well, this exchange that I as an investor used or as a trader used didn't have the required industry standard level of liquidity and therefore has whatever engaged its legal responsibility?
Yeah, well, I mean, I think, of course, it's a legal question of whether the exchange guarantees that level of liquidity or whether that risk is taken by the traders. But if there is liability, I think I can imagine that approach to work. I mean, one question is obviously whether ETH prices react to every single trade, or whether there is, again, back to this black box algorithm, whether these flash crashes actually would impact the ETH behavior or not at all. But if it does, absolutely, and there is liability, I think you can definitely use the approach of looking at the other exchanges and take the average price. The problem with ETH, as I said, is that actually, if there is mispricing, or maybe I didn't, but if there is mispricing, that's very long-lived. They don't, if there is a crash, the price by the time it recovers, I mean, as I said, it has never recovered to the May 19th level in the Binance case. So that would be a lot of people affected, and I would imagine that the exchanges are protecting themselves against these kind of losses. But once
for sure they will after this case is over.
Yes.
Absolutely. Thank you so much, Dora, for an illuminating presentation, and I certainly learned a lot. And I wanted to thank everyone for joining us. Our next event is on 3rd of May. We will be in conversation with the creators of In Mediation, which is a case and hearing management tool. It's going to be a show and tell presentation of their tool. And I hope you join us at that time. Thank you very much, everyone. Have a good rest of your day. Thank you, Dora.
Thank you.